off after the break with the statement of cash flows, and I want to come back to risk analysis at the end. Maybe we'll end up at that next week. Okay? All right. If you guys can take your seats, let's start where we, not exactly where we left off. I want to skip the liquidity ratios and the ratio analysis. We're going to come back to that at the end of this chapter. But I just would like to get into cash flows today. So I'm going to go through an introduction to cash flows. Again, I'm going through the basics just to make sure everyone is on the same wavelength, and then we're going to get into the prep of a cash flow statement, or as much as we have time for today. So, all right, so far, up to this point, we've learned about the balance sheet. And what does the balance sheet tell us? Financial position for what types of, so what do you think of? What are the sections of the balance sheet? Assets, liabilities, and equity, right? As of a particular date. I think it is. Thank you. I hope, well, actually, let me just see. I put it on, but knowing my luck, it will not be actually. Let me just make sure that it actually has sound. Hello? Yeah, okay, it's on. Yes. Good, thank you. So now you can actually get this information somehow online. I don't know when that'll be, but all right. So it tells you your financial position at a particular point in time at 12/31/2012, okay, or as of, okay, but it wouldn't say for the year ended. We've learned about the income statement, and in the income statement, what are we looking at? Revenues and expenses. What else? Losses and gains, yep. So that's going to tell us the profit-generating activities for a particular period. So you're going to see something like for the year ended 12/31. Okay? And I have here GAAP generally requires the use of accrual basis financial statements, right? So we're focusing on accrual basis. In the income statement, we're focusing on accrual basis for the balance sheet. And we've also learned about disclosure. We talked about financial disclosure up to this point, which is required as a supplement to these statements, right? Unfortunately, the accrual basis financial statements are not giving us the whole story that we need to know. The accrual basis financial statements plus all those disclosures are not telling us everything we need to know. So for example, we can have lots of sales but not collect a lot of cash on those sales. Okay? We could have great salespeople but not good collections people. Okay? So these accrued sales are going to increase our net income, but they're not going to reflect how much cash we've actually received. So you can have many transactions that will increase your net income but have absolutely nothing to do with any cash that you've received. And this is accrual basis financial reporting. That's what it does. On the flip side, yes. Oh, yes. Okay. So again, on an accrual basis, when we report our sales, we're reporting sales that we have made, okay, revenue we've earned, but not necessarily the cash we received on those sales. On the flip side, I'm going to get ready to scroll over, we can incur expenses. We can get a utility bill, a phone bill, but we may not pay that bill by the end of the period. Okay, so we can incur expenses but not pay on those expenses. We all know those times when we get our cable bill and we just decide we're not going to pay it for a while until the company says, you better pay it or we're going to send you to collection, whatever they say, or we're going to turn you off. Okay? So sometimes we have expenses that we don't pay in a timely fashion. So these expenses that we accrue are going to decrease our net income. But they don't reflect how much cash we've actually paid. So we have transactions going in both directions on our income statement that have absolutely nothing to do with any cash we received or any cash we've paid. Okay, any questions on anything I've said so far? This is intuitive, makes sense, right? So far we've kind of pointed out that using the accrual basis, we can get information about our net income, but we don't necessarily know what kind of cash has come in or what kind of cash has come out. In addition to that, we can also receive money or pay money that is not related to our primary business purpose. So many companies, I've used this example before in this class, companies may sell property. Okay, I even say we can buy or sell a building and receive money even though that is not our primary business purpose. So you can have a company that has a big infusion of cash, right? They have a ton of money in their bank account, but it turns out, I think the example I've used here in the past is they sold a building in Manhattan that they bought 100 years ago. It's worth millions and millions of dollars. They sold it. They have a big infusion of cash. By selling that building, they receive money, but that's not, is that likely to happen next year? No, so they may have a big infusion of cash now, but is that going to help keep them afloat in the long run? No. So these transactions may increase or decrease our cash balance on the balance sheet, but it's not related to what we do primarily as a business. So far we've noted that on our income statement we have lots of things that may increase income or decrease income, but don't reflect any kind of cash that's come in or out. And then on this flip side of that, we can have things that increase or decrease cash on the balance sheet that may not happen again, right? They just may be a one-shot deal. Do you need me to? Okay. I have too many blanks on this one. Okay. Okay. So where we're going to go next, there's another way you can receive money that can give you a big infusion of cash. Any thoughts on what that could be? Loans. That's exactly right. So you can receive money from buying, or I'm saying receive money. You can also pay money to buy an asset, like a building, but I'm using the receive money. But you can also receive money from a loan, or you can, on the flip side of that, repay some loan. Okay, and this also will impact your cash balance, right? You may have a lot of cash coming in from a loan or be paying out a lot of cash that you owe on a loan. So this transaction will also increase or decrease cash on the balance sheet, but it is not, again, cash from primary business operations. So again, why does that matter? Why do you think that matters? Where the cash comes from? Yes?
Determining future performance.
Right. Is this determining not only future performance, but the future ability to continue to exist? Right? Solvency. Are you going to be able to continue? You may have a lot of cash now, but are you going to be able to continue to exist in the future and meet your obligations if you don't have cash coming in like that in the future? So the bottom line in this just beginning of discussion about cash flows that we're getting into is all sources of cash are not equal. If you were going to invest in a company, where would you want to see that cash coming from? Operations, right. Not from selling a building necessarily. That might be a nice thing to have, okay? It may be nice to know that they're investing in a building if you're thinking about investing in a company. Why? What can that be a sign of? They're trying to grow, right? They may be making decisions that are in the growth direction, okay? So there are different reasons why you may want to see different things happening, but in general, if you see a company existing on loans and selling its assets, that doesn't say a lot for the company's ability to continue to exist as a profitable company, okay? Because that might be something they're doing to try to stay afloat, okay? So, the statement of cash flows is very important because the things that I've talked about so far, I said, we know that there are things that increase or decrease net income that don't affect cash. Have we learned anything that tells us what affects cash yet? We haven't learned anything that specifically says the cash that we received on sales or the cash that we paid on our bills. We haven't looked at anything like that. We've looked at the income statement on an accrual basis, which tells us only the sales that, the revenue earned and the expenses incurred. Okay? We can find out what our cash balance is on the balance sheet, but we don't necessarily know where that cash came from. Okay? And so seeing a high balance or a low balance in our cash, specifically looking at cash, may give us an indication of our liquidity at that time, but it doesn't necessarily tell us where that